Welcome to this deep dive. Today we're unpacking a huge stack of financial reports and market analyses from March 2026. And our mission here is to really quickly distill the core insights into how this escalating U.S.-Israel-Iran conflict is just completely rewriting the traditional rulebook on safe haven assets.
Yeah, it really is. I mean, looking at the data, the traditional playbook is effectively being torn to shreds right in front of us.
It is. So let's start with the golden dollar paradox, because historically, kinetic warfare breaks out, capital panics, and it floods straight into gold.
Right.
And initially that did happen. Gold spiked to a record $5,418 an ounce.
Exactly. That was the classic panic move.
Yeah.
But then it just hit a wall. It tumbled right back down to around $5,081. The momentum just vanished.
Which is wild. It's like you grab your umbrella in a storm expecting to stay dry, but the wind just violently blows it inside out. I mean, what broke that historical correlation?
Well, it really comes down to geography dictating the bond market. The immediate fear was that the Strait of Hormuz was closing. Yeah, and that sent oil prices completely vertical. And when energy spikes like that, you aren't just looking at localized inflation. You're looking at a massive global economic tax.
Which instantly forces the market to reevaluate what the Federal Reserve is going to do.
Exactly. Once markets priced out those anticipated Fed cuts, we saw this aggressive repricing in the 10-year Treasury yield. It violently tipped the real rate calculus away from gold. Yields just shot back over 4%.
Wow. So the U.S. dollar basically stepped in as the ultimate global sponge, just absorbing all that panic capital.
Honestly, it acted more like a black hole. Its gravity, driven by those 4+% yields, just pulled liquidity right away from zero-yield assets. Gold simply couldn't compete with a surging high-yielding dollar.
Okay, so if fiat-backed yields are weaponizing the dollar against gold, you would expect an absolute bloodbath in risk-on tech assets.
Right.
But looking at the exact same data set, Bitcoin actually gained 13.4%. It blasted past $74,000, while the S&P 500 and gold both dropped.
Yeah, that was definitely the standout anomaly.
But wait, I have to stop you there. Bitcoin as a bunker. We're talking about an asset notorious for massive weekend swings. How does anyone look at a kinetic war and decide, a highly volatile digital token is the safest place to park their capital?
I know it sounds totally backward, but it forces us to completely redefine what safety actually means in this specific environment. The analysis from Arthur Hayes points to this concept called net energy loss.
Okay, what does that mean exactly?
Well, war destroys energy and resources at a massive scale, right? But it does so without creating any consumable economic value in return.
So when governments inevitably print money to fund that literal destruction, the currency in your pocket buys way less of the remaining actual goods.
Exactly. That is the hidden inflation tax, and that's the whole mechanism here. Now, notice how Bitcoin behaved initially. It actually dropped 7% on the breaking news.
Oh, wait, really?
Yeah, it acted exactly like a standard risk asset when the geopolitical shock hit, but then just ripped upward.
Ah, so that tells me the market suddenly stopped pricing in the geopolitical shock itself and started pricing in the fiscal response to that shock.
You nailed it. The realization set in that this immense economic pressure will force the Federal Reserve to debase the fiat currency just to pay for the conflict.
Wow.
In a scenario where the dollar's purchasing power is being actively diluted, a mathematically capped supply asset like Bitcoin completely transforms. It stops being a speculative tech bet and becomes an explosive hedge against sovereign currency debasement.
That is fascinating. So for you listening, why does this all matter? If you're still relying on that classic 60-40 portfolio, 60% stocks, 40% bonds to protect your wealth through this, you are fighting yesterday's war.
Yeah, the math has violently shifted. We are moving entirely out of an era of wealth accumulation and straight into an era of wealth defense.
Because the real threat to your assets isn't just market volatility anymore. It's the inflation and interest rate mechanics happening right beneath the surface.
Right. Safety is no longer about avoiding price swings.
Yeah.
It's about avoiding the systemic dilution of your purchasing power.
Which leaves us with a pretty unsettling question to wrap up on. If traditional safe havens like the U.S. dollar and treasuries rely entirely on the promises of powerful nations, and those same nations are increasingly forced to weaponize their own currencies to sustain global conflicts, is the whole concept of a safe haven actually just an illusion? I mean, maybe it's just tied to whoever holds the most power right now, just waiting for the wind to change.